And welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani, and once again, this time only two, of the very best in the business with us. First, Dave Noddick, my old friend, CIO and Director of Research at ETF Trends, and Burton Malkiel, who's a Professor Emeritus of Economics at Princeton University and author of the legendary investing book, A Random Walk Down Wall Street. Professor Malkiel was one of the first to ever note that an average investor should just stick with index funds. That was way back in 1973 when the first edition of Random Walk was first published, and it's now in its 12th edition. Guys, thanks very much for joining us. Normally I'd start with the ETF question or something like that, but I got to start, guys, with the markets right now, down over 800 points in the Dow Jones Industrial Average, and really been trending down for a while now. Professor, could you just give us a minute of your thoughts on the markets right now? I know you pioneered the random walk concept, but it certainly seems like the market is reacting to the news of stimulus or the lack thereof, and the fact that the reopening story for the moment is not going very well.
No, exactly. I never said the market did not react to news. It does react to news. But true news is something you can't predict from the past. And that's one of the reasons why the market behaves somewhat randomly. What's happened is there was a much larger spike in coronavirus cases than we had anticipated. We had anticipated there would be some stimulus passed before the election. That does not seem to be the case right now. And so the market is selling off. But look, what we do know is that at some point, the virus will be contained. At some point, we will have effective treatments. At some point, we will have an effective vaccine. At some point, we will get stimulus, maybe not before the election, maybe not even before the new administration comes in. But at some point, we will get the stimulus. And so I say to investors, don't try to time the market. Certainly don't sell out now in view of the market down over 800 points. Stay the course. And the best investors are ones that don't try to time the market.
And Dave, you and I talk about this all the time. And certainly today, it doesn't seem to matter whether you're high beta guy, a low volatility guy, a momentum guy, a value guy, a small cap guy, whatever. Pick your factor. It doesn't seem to matter that much today, Dave.
Yeah, it's all going down. And, I think that part of this is a bit of a recognition that the hope we had that the K-shaped recovery, for lack of a better term, was going to become a little more homogenous. I think that's going out the window. We've got some big earnings coming out this week, folks like Caterpillar. I think that's getting a lot of people focused on industrials, which have had a great 3-month run and are one of the things really taking it in the teeth today. I think people are just coming to grips with, as Professor Malkiel is saying, the virus is going to be here. Stimulus isn't, at least for some period of time. And that leaves us really on the back of what companies are actually able to do. It's hard to get behind industrials, energy, and those sectors that have really been hurt today.
Yeah. Professor, I wonder if you can, for people who are still not quite aware of what your central contribution, I think, to the whole financial literature is, maybe you can reiterate for us briefly. Could you describe what a random walk is, and where did the phrase random walk come from? Is that a mathematical phrase, or does it describe something in particular? Just give us 30 seconds on that. For
random
people who aren't
walk is
familiar
a
with your main thesis.
mathematical term. And what random walk really means is the market cannot be predicted in advance. I don't know what's going to happen. Is the market going to continue to go down tomorrow? Is it going to bounce back? I don't know, and nobody else knows. So the best thing to do is stay the course. And the best thing to do, since we don't know whether growth is going to be better than value or small is going to be better than large, is to simply buy a broad-based, low-cost index fund, and ETFs are now available at essentially a zero cost, and stay the course. And that's going to be the way to have the best long-term portfolio. And let me just say that Standard & Poor's, which is basically the company that measures how well index funds have done, they publish something called a SPIVA report. That is how the S&P indices compare with active managers. And what happens is year after year, 2/3 of active managers are outperformed by an index. The ones that outperform one year aren't the same as the ones that outperform the next year. So that when you compound this over 15 years, what the SPIVA reports show is that 90% of active managers underperform. I'm not saying that nobody can outperform. Certainly there are people who do outperform, but it's a tiny, tiny fraction. And if you try to go active, you're much more likely to be under the curve than over the curve. And I believe even more strongly than I did 30, 40 years ago that index investing ought to be the core of every single portfolio. And ETFs are a beautiful way to do it.
You know, Dave, you and I know this. Of course, we talk about it all the time. But there is something when I bring this up that people, it gets under their skin. People don't like the idea that everything is just random. It just bothers them. The human brain seems to want to look for patterns because that helps us order the world and make sense of the world, not that the world is a coin toss. Have you found a way to break through that sort of mental block that people have to describe what Professor Malkiel is talking about, this randomness?
Yeah, I mean, fundamentally, this is the Lake Wobegon problem. Nobody wants to admit that they're going to be average, and Professor Malkiel is, of course, absolutely right. If you want to have the highest opportunity for the maximum performance, the thing to do is buy a big, broad index fund and forget about it for as long as possible. You know, a recent study at Fidelity showed that the highest performing accounts they had were those that had either been abandoned or where the owner of it was dead. And I think that speaks volumes. That being said, I do think the active funds we're seeing, certainly in the headlines today, are a little bit different than those average active funds in that the ones that are being successful are extraordinarily high conviction, meaning they're only holding 30, 40 stocks. They're holding fairly large positions. Again, you would expect mathematically, if you put all of those high conviction active managers together, they're going to underperform the market by roughly their fees and trading costs. But I don't think that's ever going to stop people from trying to, as you put it, find those patterns and exploit them.
Yeah. Professor, this random walk idea actually applies to other fields besides the stock market. For example, I've heard you talk about basketball players before. I know you're a sports enthusiast, that even in basketball, it's essentially a random walk. Can you describe that? And do basketball players believe it when you tell them, I'm sorry, but it's really just, 50-50 whether you'll make that basket the next time or not?
No, as Dave says, it's very, very hard to believe. And the players themselves absolutely believe that there are patterns, that there's a hot hand. If you're a 50% free throw shooter and you've made 3 or 4 of your last free throws, basketball players will tell you it's much more likely than 50-50 that you're going to make the next one. And when you look at this mathematically, it just isn't true. It doesn't matter. It's like flipping a coin. If you flipped 3 heads in a row, that doesn't mean that you're going to get ahead the next time. It's very hard for people to believe. The basketball players themselves don't believe it, but it's unfortunately true, and you ought to act as if it is random and it is unpredictable. It's not that one free throw shooter who's a 70% shooter isn't going to be better than a 20% shooter. But from one shot to the next, the fact that you've been good the last 3 or 4 shots doesn't mean a thing.
Right. But you just made a key point. You're not saying that talent doesn't matter. If a 70% free throw shooter is better than a 50% free throw shooter, but they fool themselves into thinking that there are patterns there that aren't, right? It's not that talent doesn't matter. Okay.
Talent certainly
let me just move
matters.
on.
Yeah, go ahead.
Go ahead. So if the stock market is a random walk, is it a perfect random walk? I don't want to get too deep into efficient market hypothesis, but can you briefly describe that to us and why that's very important to your basic idea here. It seems to me people don't understand it properly. So generally, efficient market hypothesis says that asset prices reflect all available information. Some people seem to think that that means that it actually says that the prices are accurate. But as you pointed out, that's not exactly what it says. Could you tell us very quickly what efficient market hypothesis is and what it is not at the same time?
Sure. What it is that news gets reflected very quickly, and that prices move relatively randomly. What it's not, absolutely not, is to say that it means that market prices are always right. In fact, I like to say they're always wrong. The problem is we don't know for sure whether they're too high or too low. Now, with respect to patterns, let me admit that there are some patterns. The market, if you had a mathematician on the program, the mathematician would tell you, yes, I've looked at the pattern of stock prices, and it's not a perfect random walk. It's close, but not a perfect one. Why is it not a perfect one? It's not a perfect one because there is some momentum. And there's no question about it. It's one of the reasons why factor investors actually look for momentum patterns. But there are also momentum crashes. And the problem is momentum works sometimes, but sometimes it fails terribly. And you can't simply be a momentum investor through time and know that you're going to outperform, because you won't over time, even if you will during some periods.
Right. Well, let me just follow up with that. And Dave, I want you to jump in after this, but I want to just follow up with that question. So if the market's it's not a perfect random walk, what patterns are there? I guess we're trying to figure out what advice can we give the average investor here. So there's been some academic evidence, I know, that some factors, value, for example, small caps, momentum you mentioned, or quality generically seems to work for short periods. Is there evidence that this kind of factor-based investing really works over long periods of time? Because the ETF community has certainly embraced those factor-based concepts, which I know are based on some, earlier academic research done by Fama and yourself and others that are out there. But what can we do with this information? Does factoring work?
So I'll jump in there first.
Yeah,
I think factors.
Go ahead.
Factors absolutely can work. I think what people get into trouble is they think that there's some sort of magic bullet, and that if I only get the timing right from going into low vol into momentum, I'm going to generate many percent alpha. That's not really what a multi-factor portfolio does. A really modern, well-constructed multi-factor portfolio really just sort of changes your risk-reward paradigm fairly slightly. It gives you a little bit of extra or a little bit of risk reduction, and increasingly the evidence suggests what it's really doing is helping you reduce risk more than anything else. And I think it gets to the previous point. It's not that that all information is in every stock price and therefore stocks are perfectly priced. We have constant new sources of information. A lot of work being done recently, for instance, on the importance of liquidity and how that can impact stock prices in unpredictable ways. So I think there's always new information being absorbed, and the folks that are there absorbing it and processing it with a level head have an opportunity to generally reduce their risk a little bit.
Yeah. Professor, why don't you follow up and sort of answer that question, too? I think Dave did a good job on it. But is there any evidence that factoring work or factors work? The ETF community has certainly embraced it. And perhaps about the multi-factor approach. Dave mentioned that.
Sure. If you're going to be a factor investor, I believe in a multi-factor approach. And the reason is that the factors tend to be negatively correlated. That is to say, when value fails, momentum tends to do well. And so I agree entirely with Dave that this is possible to have a multi-factor portfolio that tends to reduce risk and gives you a little higher Sharpe ratio. The Sharpe ratio is return relative to the risk you are taking. So I agree with Dave that that is possible. Now, you want to do this, however, at low expense. If you've got a multi-factor portfolio and you're charging 100 basis points I say avoid that like the plague. But if you can get an ETF that's 10 basis points or less that does this, it's a reasonable way to invest. And there is some evidence that firms like Dimensional Fund Advisors, who have used a multi-factor approach for quite some time, have in fact been able to get a little better risk-return trade-off.
So I'm not to be too plain-spoken, but what's the poor slob who's trying to figure out what to do take away from this? Should I be going out and buying a low volatility ETF with a momentum ETF, with a value ETF and a small cap ETF? I mean, it's a little confusing to give people actual advice. I know you're not a financial advisor, you're a professor, but that seems to be the implication of what you're saying. That's a multi-factor approach. Buy all of that stuff.
Well, I think it's much better to buy a multi-factor ETF rather than have to buy the individual ones. A low-cost multi-factor ETF is a much better way to do it. And do I think it's reasonable for someone to do that? I think that's absolutely right. I would, if I did anything beside a broad-based ETF that's indexed, I might do a multi-factor one. But again, I would not expect some greater performance. You might get a little better risk reduction, but still, I think the safest thing to do would be buy a broad-based index fund. If you're interested in the factor approach, buy one multi-factor ETF with as low an expense ratio as possible. And by that, I mean something that's around 10 basis points or less. Because let me tell you, Bob, the one thing, I think we all need to be very modest about what we know and don't know about the stock market. But the only thing that I am absolutely sure about is the lower the fee I pay to the purveyor of the investment product, the more there is going to be for me. That I'm absolutely sure about. I love to quote my late friend, Jack Bogle, who had this wonderful line that in investing, you get what you don't pay for.
That's a great line. One of many Jack Bogle lines that I've used down throughout the years. The other one, my other favorite, is the line, don't just do something, stand there, meaning
stand there,
use your brain in a crazy situation and make a poor investment or change where you're doing. Let me just ask you something about behavioral economics. I had to throw in one of these questions. So people thinking that the market is efficient means that the market is rational, but I think you've cleared that up. It doesn't really do that or say that. But one of the central findings of behavioral economics is that the irrational behavior is a big driver of markets. I've talked with Professor Schiller for many times about this. People don't buy low and sell high. They do the opposite, actually. So can poorly informed investors actually lead the market astray and make it less efficient? Or is there some important philosophical or financial insight we can get from the lessons of behavioral economics?
No, as I said, I think efficient market theory does not say the market's always right, it's always wrong. But what we do know is that people, when they try to time the market, invariably they sell at the wrong time and they buy at the wrong time. They buy when everybody's optimistic, they sell when everybody is pessimistic, and that's just the opposite of what they should do. Don't try to do it. It's far better to simply buy and hold. And to the extent that you do any buying and selling, what I do recommend is rebalancing. That is to say, if you're in a situation where the market's gone crazy on the upside and your equity proportion is higher than you're comfortable with, then take a little money off the table and put it in safer assets. And when the market has, in fact, dropped precipitously and everybody is terrified about what will happen in the future, and your equity proportion has gone down to lower than the proportion with which you should be and you're comfortable with for the long run, then go and sell some of the safer assets and buy the market. So I do agree with rebalancing, but I do not think that you should actively try to time the market.
You know, Dave, you wrote a great story a number of years ago, which I still quote and go to, called The Folly of Market Timing, where you look at the simple observation that if you're not in the market for like the 10 most important days of the year, you're basically lost. If you are in the market at the worst days of the year, you still lose. But your point of your story was nobody knows. There are 10 days that are really important and nobody knows what the days are.
Yeah, and I feel like that's true not just in investing. I think it's true in life, right? And, you know, I think most of us get paid for 10 days at work a year, and we just don't know which 10 days those are going to be. So we have to get ready for the rest of them. You know, but I think the point here is well taken. You know, your question, Bob, you know, what's an ETF investor to do? Well, I mean, it's in the name of your show, ETF Edge. If you don't know what the edge is, then you don't have one, and therefore you should just be in low-cost indexes. It's not that there isn't information out there available that people can get an edge with. It's just infinitesimally small and very difficult to get.
Yeah. Professor, I have to talk to you about ESG briefly. You wrote an op-ed in the Wall Street Journal a few weeks ago. You said it was entitled, "Sustainable Investing is a Self-Defeating Strategy." Love that title. Where you went on to criticize ESG, saying, among other things, the scores are dramatically different depending on which ESG you look at, which is true. Could you tell us briefly, what is your concern about ESG?
Well, my concern is that companies are very complicated. And it's impossible to say what's a good company and what isn't. There are various services that give companies ESG scores. And when you look at the pairs of these raters, they're correlated. The correlation is about 0.4. But they're also, that means that there's tremendous disagreement among the ESG raters. And just to put the 0.4 in perspective, for bond ratings, the correlation between Moody's and Standard & Poor's in bond ratings is 0.99. That's where the rating really means something. 0.4 means that some raters would think that some company is great, another rater will think some company is poor. The utility that burns coal now, that one rater thinks is absolutely to be totally avoided, but that utility is making huge investments in wind power, and another rater says these guys are really good and they've promised to be carbon free in a couple of decades. Who's right? We don't know who's right. And then when you look at the ETF portfolios that are broad-based ESG portfolios, look at the top 10 stocks. And are you really going to feel good about owning them? What are they? Well, Facebook is typically in the top 10. Visa and MasterCard are in the top 10. So should I be happy owning Facebook where there are problems of personal privacy, where there's problems of misinformation and disinformation? Should I be happy owning Visa and MasterCard that charge interest rates to poor people of 20% or more? I don't know. I don't look at those ETF portfolios and feel terribly good about it. If you want to be an ESG investor, I say have the core of your portfolio a broad-based index fund, and then if you want to go and invest in renewable energy, then either buy companies or an ETF that's a pure renewable energy company. But don't buy a broad-based ETF that is supposedly a great moral way to do good things for everybody and make money, because you're fooling yourself if either that the companies are all good, and you're fooling yourself if you think you're going to make more money that way.
You're a big proponent of that, what I call the 10% rule. You've said this before with other things. So if people have a sudden itch to think that they're great stock pickers all of a sudden, fine. Take 10% of your income and go and play around with it, but keep the rest in the low-cost index funds. It's almost like a 10% rule you're espousing. You said almost the same thing with ESG. If you feel a bit strongly about renewable investing, then take a little bit of your money and do it, but keep most of it in index funds. Is that a fair characterization of the way you feel about it?
Absolutely fair. I'm not saying that you shouldn't stray and buy other things. You can do so with much less risk if the core of your portfolio, your serious money, is indexed. I'm actually, this will surprise you, but even Jim Cramer has come to the realization. He used to say that index funds were terrible. Now he says, put your serious money into an index fund and then take your mad money, which is the name of his show, and you can put it in individual stocks. You can put it into factor ETFs. You can put it into an ETF that has a particular mandate. And I myself, I've got my serious retirement money entirely indexed, and then I'll buy individual stocks and I'll buy individual ETFs because I can do so with much less risk because the core of my portfolio is indexed.
Dave, how should, just to end this ESG conversation, how should we look at ESGs? Is it kind of a factor investing? Is it a separate asset class? I mean, what do you advise people who want to have a diversified portfolio? I'm trying to figure out what's the right way to look at ESG. What is it?
Well, one thing that Professor Malkiel is absolutely right on is that no two people really can even agree on what we mean when we're talking about ESG. For one person, it's about climate change. For another person, it's about regulatory compliance. And I think the reality is you have to go into an ESG investment with your own definition. What is important to you? And certain components of ESG, particularly things around governance, for instance, have actually proven to be excellent risk management metrics. And there are whole portfolios that are really focused on that G in ESG that have done quite well. And, McKinsey just published a study saying roughly 63% of the studies done on ESG portfolios suggest there's net positive impact on performance. So I don't think it's true you have to think about this as a thing you're giving up. I think ESG considerations are becoming part of how major institutions allocate trillions of dollars, and therefore to ignore it entirely is to potentially put yourself in front of a steamroller. So whether you believe in ESG or not, it exists, and a ton of money is chasing it, and therefore it's going to impact securities prices. So you've got to be paying attention.
Thank you, Dave. Very good summation, as you always do. We're going to continue this conversation with Professor Malkiel a little bit on the history of the random walk. You might be wondering, why are we spending all this time talking about random walks and efficient market hypothesis, and what the heck are these people talking about? This is the foundation upon which the concept of index investing is based upon. It's the theoretical foundation. It's the academic foundation for the whole thing. So if you're going to do this kind of investing and you're thinking, well, why am I buying an index? There's a reason why. And Professor Malkiel, Eugene Fama, and others have historically been very involved in this discussion. And A Random Walk is now in its 12th edition, and it's a very important book. It had a big impact on me when I read it 25 years ago. So I want to thank everyone for joining us. We're going to continue this conversation in the podcast with Professor Malkiel, a little bit on the history of the random walk. But I want to thank Dave and Professor Malkiel for joining us for this portion. I want to remind everyone you can see everything we've got, etfedge.cnbc.com. And remember, we'll be talking more with Professor Malkiel in the podcast shortly. That's it for this week's ETF Edge. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.